day all. Ira Epstein of Linn Associates with your agriculture update for this Thursday. It is D-Day, and let's wish the best to our vets. It is June 6, 2019, just after 3:05 p.m. Central Daylight Time. Well, mixed day today in the grains. You have the corn that got a bit of a bid here, coming off 407, actually closing today 5 3/4 higher at 420.5. Beans were under pressure a good part of the day and still stayed under pressure, although 10 cents off the lows. And the wheat market soared on news that the Russian crop could be in some jeopardy. And with tight supplies around the world, people just keep wondering what's going on, and with trade situations the way they are. Now, talking about trade, there's a meeting supposedly going on right now between Mexico and the U.S., which obviously impacts agriculture, but we'll find out more probably tomorrow or the day after that. And the reason is, from what I read on Bloomberg, there are no high-powered U.S. cabinet members at the meeting. It's more staff level, as the president is saying if they don't get anything done, the 5% tariffs on Mexican imports in the U.S. are going to go up 5%. So we will find out just what's going to happen. Mexico did move its army yesterday, that's Wednesday, and took about 350 people out of a caravan into an immigration center. Then they got another 120. So it is 500 people, which proves things can be done if people put their mind to it and start locking down the border between Mexico and Central America. Maybe that's the whole solution. I don't know. I can tell you that what I was thinking in the energies, I think, is going on. This $50, $51 range in crude, $60 range looks plain cheap in the energy. So you got to keep your eye on that. In soybeans, when you look at the weekly area chart, the market went up this past week, got up towards that 18-week average of closes. Market for the week is down 9 cents, staying under it at least for the moment. When we take a look at gaps, if you'll recall, I've been saying for the past few days that if the market comes down, the most likely gap to first be attacked would be this one if it fell. Today, if you take a look at the low of the market was 857 3/4. If I come back here and you look at the high of this day, it was 858 1/4, and then the next day the market gaps with the low of 863.5. So you have to get under that 858 1/4. You know what today did? Today the market got down to 857 3/4, filled the gap. That doesn't mean this gap may not be attacked. My guess is charts don't like to leave gaps. Could it? It could, but we'll see what goes on, obviously, over the next few days. You have stepped out of the uptrend. You did that yesterday with a pattern now of a higher high and a lower low. In terms of resistance and support, well, one resistance level could be this 899.5 area, and that number is going to start falling very slowly as prices now start stalling out right here. We'll see where that comes in. The support's the lower 18-day average of closes. The Bollinger Band was acting as a point of resistance, but it's really this combination that's coming together. 899 Bollinger top, 899.5 100-day average that will act, if the market got up there, as strong resistance. Support to me still in this 847 3/4 zone, and momentum has turned on the market down, which puts, unless weather changes, the likelihood of this market trying to get back to the 18-day average of closes. Now, I'm covering what I just said with if this weather changes. When you're in a weather market, sometimes it's not just U.S. weather, it's world weather that can affect the market. In our case, you know that we're having very serious issues. Everybody's trying to figure out for next Tuesday what the numbers, and they're going to be putting their pens to it. What do they think yields will be in corn, soybeans? Even though they're nowhere near that point, they'll start figuring acreage, and they're generally wrong on the acreage. And the reason is, in a big weather event like this, people tend to underestimate, not overestimate, underestimate lost acreage. When you're looking at the meal, you can see how this market broke through yesterday and followed through today to the downside. I'll stick with my idea that you might be headed for that 100-day average. But keep in the back of your mind that both in beans, as long as you're over the 18-day average in meal, you still have an overall bias that's to the upside. So no, I'm not in the bear camp. A correction camp as a technician is probably where I'd label myself. Momentum turned down here, and adding the insult to the injury, you can see the reversal in the crush spread where oil all of a sudden got a strong bid, an outside day up today, running into or trying to get back towards that resistance at the upper Bollinger Band. But when oil's gaining on meal, it's typically not a sign of bullishness, and that's what I think is going on right there. In the corn market, you've lost the embedded reading, which often, I cannot use the word always, but often is where I'll stay, leads to price in the 18-day average making a run at each other, and that's what I think is going on. The market got down, admittedly, today, nowhere near that number. You're still 7 cents away. That's not a close call. That is still far away as far as I'm concerned. Even if you went up over the recent high of 436, the high made 3 days ago, you would have a pattern of lower low, higher high. So I think this market is now in the area where this big bull advance has come to a temporary end and we're waiting for some other event, even though the market has an upside bias. In the wheat market, you lost the embedded reading a couple of days ago. Often that leads to that challenge, I think, of the 118-day when they're together. But something else happened today. What happened is you got a bullish crossover. The 18-day, do you see that, got over the 100? And I think that in part, that kept the market from getting down that low. You're still overbought as can be. You're still in an uptrend. You had an outside day up. Therefore, what you don't want to see is on Friday or Monday, the market take out the lows of an outside day up, because that would get the chart looking fairly ugly at that point. But at this point, you have an overbought market with an uptrend, support with a bullish crossover coming in at 483 and a quarter. In the sugar market, we've been fighting for the past 1, 2, 3, 4, 5 days up over every which way against that upper Bollinger Band while in an uptrend in an overbought condition. If the market extends the rally, I wouldn't be surprised to see the 100-day average act as another resistance point. I think the market's still going to fight a battle trying to stay under that upper Bollinger Band, but we'll see if it does it. Still bullish, though. In the coffee, the break yesterday took the market out of the uptrend. You've lost the embedded reading ability. So the rally today is interesting. What the market did is it's fighting a battle right here. I think you see this. The green line is the 100-day average of closes. Is that all the market's going to break? That's the question. And are you in a trend? I don't define this as a trend. You've got a lower low and a higher high. So I think the market is now noise, with an upside bias trying to find support against the 100-day average. If you take out 97.90, then the 18-day average comes into play. In the cocoa market, again, it's one of these funny markets where you have the higher high, lower low. It's difficult to trade off of that. The 100-day average, that's right here, acted as the support. And you can see how the market was breaking, got through the 18. Next level might be the 100-day, as it turns out it was. Now the market's back over the 18-day average, but I wouldn't be surprised to see it just hang around here because you've got divergence. You've got momentum pointing down, no trend, and bias up. In the cotton market, battleground's been the 18-day average of closes. You try to break out down, you don't follow through. You tried to break out up, you're not following through. What you're really doing is going sideways in the Bollinger Bands as momentum is overbought, trying to give a bit of a correction. In the cattle market, you still have a pattern of lower highs, lower lows, but you are oversold as can be, and you're getting divergence again. Notice how momentum's trying to climb up. Prices today up a fraction with it. Now, if you were to take out 105.30, the pattern could change to higher lows, higher highs. I would still then look for resistance at the 18-day average, but I think that would be a signal to the bears, be careful here. In fact, I think it is already. In the feeder cattle, we were talking yesterday if this market can get a rally up to the 18-day average to find resistance. At the same time, you're no longer in the oversold category. So what the market does probably tomorrow against this level, if it gets up there, is going to be interesting. You did have an outside day down, so if you take out today's high, one of my charting rules is the market often goes back to the closest of the key averages, and that would be the 18-day average in this case. That does not mean the trend would be up. Even under the best case scenario, if you were to take out this high of 143.45, you'd have a lower low, higher high. I'm not seeing a clean trade there. In the hog market, Momentum is oversold. This market's in a warning sign. It also had an outside day up today. Resistance, as I see it, could be the 100-day average at 87.70. I think a question is, can you get up to the upper 18-day average of closes? Momentum oversold. I think you've taken the bears out of the play is what I think's going on, and the market's just trying to figure out what the next step is. You know, as I'm talking about this, we write like mad on the grain markets. We talk to commercials, we talk to end users, we're talking to the farmers, and of course, we're always talking to the speculators in the market. But we get a handle on what's going on in the fields, what's going on in terms of the elevators bidding for the markets, and you see all that in our research. So if you're, be it in the grains or any part of this ag industry, you might want to see what we write for our customers, and you're entitled to a free trial if you haven't tried us before. All you need to do is give us a call at 866-973-2077. You can also go to our website at www.iraepstein.com. You'll see our carousel of free offers. Click on it, choose what you want, and away you go. You don't have to get all that information. You can pick categories. I'm Ira Epstein. You have a great day.